In June 2020, one of Europe's most shocking corporate collapses unfolded. Wirecard, a German fintech darling, admitted that 1.9 billion euros, so over $2 billion, simply did not exist. One moment, Wirecard was celebrated as a global success story of German innovation in financial technology. The next was exposed as one of the largest accounting frauds in history. This is the story of how a company trusted by regulators, investors, and banks managed to hide billions on paper that never existed, and how the truth finally came out. To understand why the Wirecard scandal mattered, you first have to grasp its rise. Wirecard AG was founded in 1999 in Munich, originally processing payments for mobile content. Over 2 decades, it positioned itself as a fintech pioneer, facilitating online payments for e-commerce platforms and global merchants. By the 2010s, it marketed itself as a leader in digital payments, rivaling giants like PayPal and Stripe. Its stock was listed in Germany's prestigious DAX index, the first ever fintech company to achieve that. Wirecard's growth story was compelling. Astonishing revenue growth, global expansion, and promises to disrupt traditional banking itself. Investors bought in. Analysts praised its business model. Regulators considered it a success story of digital transformation. But beneath the hype, something rotten was brewing, a complex web of misleading accounts, fake transactions, and outright lies. The first cracks appeared years before the collapse. Short sellers, journalists, and analysts began questioning Wirecard's financials as early as 2015. These were investors who bet that the company's stock price would fall, precisely because they suspected accounting irregularities. Among the most vocal critics was the short-selling firm Zatara Research, which published reports alleging that Wirecard's Asian operations were opaque and possibly fraudulent. These claims were dismissed by management as the work of short sellers betting against us, and at the time, regulators appeared to give Wirecard the benefit of the doubt. Meanwhile, Wirecard continued to report strong profits and rapid growth. Its stock price climbed, its executives became media darlings, and its CEO, Markus Braun, positioned himself as the visionary leader of a European tech success story. Alongside Braun were other senior executives whose reputations rose with the company. Among them was COO Jan Marsalek, an enigmatic figure later revealed to have ties with clandestine intelligence networks and controversial overseas actors. But the underlying problem was structural. Much of Wirecard's supposed profitability came from its third-party acquiring business, partners in emerging markets who processed transactions on Wirecard's behalf. Wirecard claimed that these partners operated in Asia, the Middle East, and Africa, and generated substantial revenue. Yet this business, opaque, difficult for outsiders to verify, and dependent on intermediaries, was never fully audited in a verifiable way. It became the proverbial black box at the heart of Wirecard's reported success. Critics later argued that EY failed to scrutinize Wirecard's accounts aggressively enough, especially given the clear red flags raised by journalists and short sellers. Questions circulated about whether EY was too close to its client, or simply overwhelmed by Wirecard's evasive disclosures. Wirecard admitted that 1.9 billion euros supposedly held in trustee accounts in the Philippines did not exist. According to the company, external auditors had tried to confirm the balance with correspondent banks, only to be told there was no record of the funds. Wirecard then issued a bombshell statement, acknowledging that it had probably been deceived by third-party partners about the existence of these assets. In the simplest of terms, the company had been reporting revenue and assets that were never real. The market reacted instantly. Wirecard's stock price plunged. Regulators froze accounts. German prosecutors launched criminal investigations. Investors scrambled to understand how such a colossal mismatch, $1.9 billion unaccounted for, could have been reported for so long without detection. The unraveling was swift and dramatic. On June 22, 2020, Wirecard filed for insolvency, the first ever DAX-listed company to do so. CEO Markus Braun resigned and was arrested shortly afterward. Within days, he was charged with accounting fraud, market manipulation, and embezzlement. Other senior executives were arrested or sought by authorities. Jan Marsalek, the former COO, became one of the most wanted men in Europe. As of this writing, his whereabouts remain unknown, with reports tying him to various foreign intelligence networks and far-flung regions. The German financial regulator, BaFin, faced intense scrutiny. Critics argued BaFin was slow to act and, at times, seemed to defend Wirecard against short sellers rather than investigate the core allegations. BaFin had even gone so far as to fine journalists and investors who raised concerns, a move that in hindsight looked like regulatory overreach in defense of a faltering company. In the aftermath, investigations dove into the mechanisms of the fraud itself. It became clear that Wirecard had used a variety of methods to inflate its financial results. The company booked fictitious revenue, often through phantom partners. Fake accounts and confirmations were produced, documents that auditors relied on, but that did not tie back to real bank records. Complex webs of subsidiaries were set up in jurisdictions with weak oversight, making verification difficult. Executives applied pressure on auditors and regulators and threatened critics aggressively with legal action, creating an environment where scrutiny was stifled. The scandal also sent shockwaves beyond Wirecard shareholders. Banks that had lent capital to Wirecard had to, write down losses. Pension funds that held Wirecard stock saw sudden declines in value. Clients who relied on Wirecard's payment services had to scramble for alternatives. Confidence in Fintech, especially in Europe, was shaken. Investors began demanding stricter auditing standards and greater regulatory oversight. Eyewitness testimony and internal documents released during prosecution further revealed just how deep the deception went. Wirecard was not merely optimistic in its reporting. It systematically fabricated lucrative overseas operations, built artificial partnerships, and issued financial statements that auditors could not substantiate. In internal communications, executives sometimes expressed awareness of the issues, yet publicly maintained confidence and denied any wrongdoing. Perhaps the most chilling aspect of the scandal was how long it persisted. For years, questions were raised. Yet the company continued to grow, remained in the DAX, and maintained the trust of regulators, auditors, and the market, until the facade collapsed under its own weight. The Wirecard scandal has since become a case study in corporate governance failure, regulatory complacency, and the dangers of unquestioned faith in financial statements. Universities, law firms, and auditing bodies now analyze Wirecard as an example of what can go wrong when oversight is inadequate, and executives are allowed to operate with too little scrutiny. The fallout also put pressure on auditing reform. EY, which signed off Wirecard's accounts for years, faced reputational damage and lawsuits. Questions were raised about how auditors failed to detect fraud, even with access to key financial documents. Investors began asking, if one of the big four accounting firms couldn't spot nearly $2 billion in missing assets, what can we trust? In Germany, the scandal prompted calls for regulatory overhaul. BaFin's role has been reassessed, with critics urging stronger enforcement, greater independence, and more proactive investigation of firms with red flags, especially those in rapidly growing sectors like Fintech. One of the most enduring questions from the Wirecard saga is deceptively simple. How can $1.9 billion just disappear? The answer has many layers. Deliberate fraud, ineffective oversight, regulatory blind spots, over-reliance on audited numbers, and a culture that prized growth and narrative over verification. In that sense, Wirecard wasn't a failure of technology. It was a failure of accountability. Even today, as prosecutions continue and civil suits wind through courts, the ripple effects of the scandal influence how regulators and investors evaluate corporate disclosures. Some countries now mandate stronger verification of overseas revenue and tighter controls on third-party partnerships, precisely where Wirecard's problems began. If this breakdown gave you clarity beyond the headlines, hit like so more people can see it. Subscribe for deep dives that go behind the numbers and explain how global financial scandals really happen. Share this with someone who still thinks corporate fraud is something that happens elsewhere, because Wirecard proves it can happen at the center of Europe's financial system. And remember, in the world of money, trust is earned, not assumed.